Hi everyone, New Jersey Forensic Accountant here, and today's topic we're going to talk about two key metrics for evaluating the performance of a company. And in our firm, we use this a lot to take a look at businesses, all kinds of businesses. And what we find is that there's a lot of confusion out there as far as how do you actually judge whether management's doing a good job with a company. And there's all kinds of stuff, and it obviously can go into lots of detail, but just two quick and really good metrics that tell you how a company's doing. And I'm going to take you through this. I'm going to talk how they calculate. I'm going to show you how they calculate. I'm going to show you how we used it in court for testimony. Now, return on investment, right? Okay, that's what people are looking at. We have a little bit different take on this. We like to say return on invested capital, but companies create value when an investment in a business yields a return in future cash flow. There's no way around it. Cash flow is the most important thing in a company because whether it's this year, next year, or 10 years out, that's what people are doing. They're saying, I'm putting X amount of money in, and when I take the net present value of those cash flows, it exceeds that, right? Generally, when return on invested capital is higher than opportunity cost, loss rate return, value is created. Right? And this is how you fairly judge a management team. If you look at growth in sales and return on invested capital over a 5 or 10 year period or a 3-year period, you really get a good view of this. Now, when I say, return on invested capital has to have a high return, higher than the cost of capital. For example, if I invest in a company and they are giving me 8% for my investment, well, they have to make more than 8% with that money, right? They got to make 10, 12, or 15% because not only do they have to pay me the 8, but they have to pay their salaries and they got to attract other capital. So they need to make a higher return. It's kind of like if I could pay someone to cut my lawn for $50, but I make $100 an hour, and if I cut my lawn, well, I'm losing $50, right? I'm better off paying someone 50 and working and making, the 50. So it's kind of the same theory, and that's how this return on invested capital works. Now, let's talk about the first key metric, growth. Okay, growth, right? Growth in what? Growth in sales. And you can see this is ideally in any company what you'd love to see, right? Okay, it's going up. But we need a way to judge that. We use what's called compounded annual growth return. You've probably heard this before, CAGR. And this is the formula for CAGR. It's pretty simple. And what we do is we basically take the sales and we look for growth or negative growth. Okay, this is a real good indicator of what's going on in the company. Now, companies may not have great growth, and you have to look at other factors because just because it's not growing a lot doesn't mean it's a bad company, but it's a concern, right? And so what's our other key metric? It's what? Return on invested capital. We're going to go through this calculation. I'm going to show you some stuff we did in court just to understand how this, I'm going to simplify it, of course, but it's important to understand return on invested capital. And some people return on investment, okay? This is capital. And again, we're going to go through it. It's basically long-term debt plus equity minus cash. Now, the formula for this is super simple. Really, you'll memorize in a second. Here's the formula. Obviously, we have psi here, pi. Only kidding. This is not the formula for invested capital. Just a little joke there. So let's talk about how we use these two key metrics, and we'll go through how we calculate them. Okay, how we use growth and return on invested capital analysis in our firm. So first thing is with privately held companies. Now, when you have a privately held company, it's great to take the sales and put them on Excel and then figure out the return on invested capital, do the calculations and compare it. But remember, when you have privately held companies, they're a little bit more tricky than publicly companies because you got to make a lot of economic adjustments. Maybe rent isn't fair. Maybe there's people who work in a company who aren't paid. So you have a lot more adjustments, but you still can use these two metrics. We use them pretty much every time we look at a company. Also, asset analysis. You can use growth. How, is it growing over time? What's the return on your capital? That kind of stuff. We use it for that. But it really shines when you're looking at public companies because public companies have lots of data, audited statements. You can go and get their 10Ks and all that good stuff. And the example I'm going to give you now is a company that we actually used this at trial. And the company that we did, that had the court testimony was MetLife. And a great website to get information on companies that's free is right here. Okay, it's MetLife. Okay, so now here is some information they're giving you on, of course, here's MetLife right there. And you could see that they're giving us the summary here, which is a lot of good stuff. Ask by, the bid, the 52-week range, PE ratio. Looking at this stuff, I don't know if this is a good company. Here's the beta, PE ratio. I mean, all this stuff is, but in a vacuum, it doesn't really tell me anything. And so what we like to do is we look at the financial statements. And you could see here, you have revenue from 2016 going up. Well, is that good or bad? We don't know, right? Net income, it went up quite a bit. Is that good or bad though? I don't know, because we need to compare it, right? To compare the numbers to each other and also to other companies. Looks like they got a lot of cash, $19 billion, right? 25. That's going down from 16 to 18. Let's look at retained earnings. That's going down too. So let's look at what here is. You could see here what we did was we have Netflix, Facebook, MetLife, Apple, and IBM, and this is what we did in the testimony. And then here we had again, this is for growth, and this is in return on invested capital. We had from 16 to 18 for growth. These are the sales, and here's our CAGR we talked about. And you could see that Netflix had a 21% CAGR, Facebook 26%. MetLife 2%, Apple 4%. IBM was actually negative. We have the stock performance. Now this is as of, we're sitting in January 1st, 2019, and we're going to say, how is this company doing? Well, here's how the stock did. Netflix stock went up 53%, Facebook's went up 56%, MetLife 27%, Apple 109%, and IBM 15%, right? Again, so they all look like they did pretty good, but we got to compare it to something. Let's see how they did compared to the S&P 500. No. So now, when I take the difference here, Netflix still has 22%, Facebook has 26%, MetLife has a negative 4%, and Apple 79%, IBM 16%. But we have to also look at the dividend, because they have a dividend, and here's the dividend yield. So when you look at MetLife, their dividend was a little over 3%. So basically, maybe they're losing 1% or breaking even. So compared to the S&P 500, so it's not a good sign, right? So you can basically buy the S&P 500 rather than buy MetLife. That's what's telling you. So not good, but let's look at return on invested capital. Okay, return on invested capital is pretty simple. You just take the equity, you add the debt, and you subtract the cash, and you divide it into net income. And when we do this, you can see, look at this, surprisingly, Netflix has a 7%, Facebook is 44%, MetLife is 15%, Apple's 41%, and IBM's 11%. And you can see MetLife really knows that they're not doing anything here, because their sales are not that great. I mean, they have a 2% growth rate. And they realize that, because that's why they're focusing on getting the return on invested capital up, right? So what this is telling us, and what we did was, the executives in this company, some were taking out up to $50 million a year. A lot of them were 10 and 20 million. And we basically said, listen, guys, this company's performance is horrible. Okay, management should probably be making a couple $100,000, not 10, 20, or $50 million. So obviously MetLife was really upset with our testimony, but that's the truth of the matter. When these numbers basically tell you that the company is not doing that well. It's basically, this company's been around for 100 years. All they do is sell insurance, take the insurance, invest it, and pay out claims. Very simple, right? Maybe an 18-year-old kid could do this stuff. We don't need a rocket scientist making $50 million. So that was our testimony. That's how we use this metric. So guys, hopefully you enjoyed this. If you have any questions, leave them below. I'll get back to you or one of my analysts. If you like this, please subscribe to my YouTube channel. Thanks a lot.